How do refunds and input tax credits work for U.S. companies? Once a U.S. business registers for GST/HST in Canada, it becomes eligible to recover the GST/HST paid on eligible Canadian expenses. These recoveries are called input tax credits, ITCs. For non-resident businesses, ITCs can significantly reduce tax costs, especially when using fulfillment centers, importing goods, or paying for Canadian services. Understanding how ITCs work ensures businesses maximize refunds while staying compliant with CRA documentation rules. What are input tax credits? ITCs allow GST/HST registrants to recover tax paid on expenses related to commercial activity. For U.S. companies, this includes expenses such as import taxes, warehousing, software, advertising, and professional services. ITCs are claimed on GST/HST returns and reduce the amount of tax the business must remit. If ITCs exceed the collected tax, the CRA issues a refund. Eligibility depends on commercial activity. Non-residents may claim ITCs only when expenses relate to taxable supplies made in Canada. If the business sells exempt services or has not yet begun commercial activity, ITCs may be limited. Proper documentation and tracking ensure that every eligible expense is claimed. Here are the expenses that commonly qualify for ITC recovery. GST/HST paid on Canadian import duties, charges from Amazon FBA or Canadian warehouses, advertising services targeted to Canadian customers, professional and legal services in Canada, software tools used to serve Canadian clients. These expenses directly support taxable Canadian sales. Refund timing depends on filing frequency. Refunds are processed through the GST/HST return cycle. Monthly filers receive refunds faster, while annual filers wait longer. Non-residents who incur significant import costs often request monthly filing to accelerate refund timing. The CRA typically issues refunds via check, which may require additional time to clear if the business lacks a Canadian bank account. Documentation requirements are strict. The CRA requires detailed documentation for all ITC claims, including invoices, import records, and proof that expenses relate to commercial activity. Missing information can delay refunds or result in denied claims. Foreign businesses must maintain organized digital records to support cross-border filings. ITCs for importers of record. When a U.S. company acts as importer of record, GST/HST becomes payable at the border. Only a registered business can reclaim this tax through ITCs. If the business is unregistered, the import tax becomes a permanent expense. For import-heavy companies, ITC recovery is one of the main benefits of registering for GST/HST. A practical example: a U.S. electronics brand stores inventory in an Ontario fulfillment center. Each time products are imported, GST/HST is paid at customs. With GST/HST registration, the brand claims ITCs to recover this tax. On its monthly returns, the refunded ITCs often exceed the tax collected from customers, creating a net refund. Another business selling digital subscriptions to Canadian users incurs Canadian advertising expenses. ITCs allow the company to recover the GST/HST paid on marketing campaigns targeting Canadian customers. Final thoughts. Input tax credits help U.S. businesses reduce their tax burden by recovering GST/HST paid on Canadian expenses. Registrants must track expenses carefully, maintain strong documentation, and choose an appropriate filing frequency to optimize refunds. Proper ITC management ensures efficient operations and smooth expansion into the Canadian market. If you'd like more insights delivered in the same straightforward style, you can explore our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.